debt is the major markets in which people invest their hard-earned money to make profits. The debt market consists of various instruments which facilitate the buying and selling of loans in exchange for interest.
Considered to be less risky than equity investments, many investors with a lower risk tolerance prefer buying in debt securities. However, debt investments offer lower returns as compared to equity investments. Here, we will explore debt funds and talk about different types of debt funds along with their benefits and a lot more. How do debt funds work? Every debt security has a credit rating which allows investors to understand the possibility of default by the debt issuer in disbursing the principal and interest.
Debt fund managers use these ratings to select high-quality debt instruments. A higher rating implies that the issuer is less likely to default.
The next logical question is, do debt funds also invest in low-quality debt instruments?
The answer is yes. Fund managers select securities based on various factors. Sometimes, choosing low-quality debt security offers an opportunity to earn higher returns on debt investments, and the fund manager takes a calculated risk. However, a debt fund which has high-quality securities in its portfolio will be more stable. Further, the fund manager can choose to invest in long-term or short-term debt securities depending on whether the interest rate regime is falling or rising.
Some example of debt mutual funds are IFC Government Securities Fund, Constant Maturity Fund, IFC Government Securities Fund Investment Plan, ICICI Prudential Constant Maturity Gilt Fund, DSP Government Securities Fund, Nippon India Gilt Securities Fund.